Hey dividend investors, today we are going to be talking to you about the Canadian banks. And the Canadian banks are, of course, some of the most strongest banks in the world. It's actually almost closely bordering upon literally a monopoly in Canada. There's like 5 banks and technically 6 you could squeeze in that really have all of the Canadians' business. Even when you start looking at banks like Tangerine, even though that's a bank, it's actually owned by one of the top 5 banks. So yeah, they have the market. It's their market to have. Nobody's going to come in and beat them, believe me. And they are starting to now expand out into the rest of the world. TD is going into the States heavily. Of course, Scotiabank is in the Bahamas and over in Europe. They're really starting to expand. Now, why are they such a great investment? Well, we're going to be breaking down 6 of the banks that I really like. Of course, the top 5 and then one more. And why their dividends are always going to be safe. Let's get down. Let's check out these banks. Okay, so as we can see, there was some really strong growth from 2015 all the way up until 2017. There was a little bit of a dip and then some really strong growth through 2018. Now, from 2018 up until before the pandemic hit, there was a pretty good trading range that they were trading in. You could, of course, trade and hold for a couple of months and then sell, but you just really want to hold during these times. They all pay a very good dividend, generally over 4%. This is Royal Bank of Canada, the biggest bank in Canada, technically speaking. And, of course, their 52-week high and low is actually pretty ridiculous. You could have actually gone up close to 50% if you got it at the 52-week low. Now, why did it get down to the 52-week low? Of course, that was the pandemic. No matter what you think about the pandemic, every single bank just died. It went down huge. And of course, whenever there's a possible recession, banks are going to be having a very bad time. When this happened, Royal Bank's dividend went huge. And of course, there was a lot of people still selling. I was buying a lot of the Canadian banks. Why was I buying a lot of the Canadian banks? It's because of this. Most of the mortgages in Canada that are held by the Canadian banks are in fact insured by the Canadian government. So even if the banks lose the mortgage, even if the person who has that mortgage literally just says, I can't afford it anymore, I'm not paying anymore, it's still insured, most of them. I think it's close to 70-ish or 80% of the mortgages right now are insured by the Canadian government because people don't have a big enough down payment to put into a house, so they have to pay for mortgage insurance. So it's covered. Of course, the person loses their house, and that's really sad. The banks are covered. The Canadian government will pay the bank back whatever is missing, and then the bank just basically sells the house. It seems like something would be against the law there, but it's not. So they're pretty well safe. Another reason why I really like the dividend, and I mentioned this earlier why I liked it, but I didn't explain why. All these 6 banks that I'm going to tell you about today, they've been paying a dividend for over 100 years, some of them up to 140 years, and during that time, 140 years, up to 140 years, they have never cut a dividend. Taking Laurentian Bank out of the equation, they're just messed. That's why I'm not talking about Laurentian Bank, but their dividends are safe. Of course, you can look at the history and say, well, you can never guess the future of whatever, but when you're looking at 100 plus years, a century, they've never cut a dividend. They have paused it, where during 2008, they still paid a dividend. They just didn't increase it, but they kept it the same, which may just happen next year. That's crazy. This is the same with all of the banks, all the major banks in Canada. And why I put Royal Bank at the end of my list, technically my first of the list, but my end, is because of this. The reason is its 52-week high was back here. It is currently trading at $1.05. It is $4 away from its all-time high, and we are still in a recession, and we are still in a pandemic. If we were out of a pandemic, I would say, okay, you can get that $4 swing and then it'll eventually go higher. At this point, that looks scary to me, so I say stay away from Royal Bank, but still at 4%. If you want a bank that is going to be the biggest in Canada, well, taking 4% every single year is a fantastic option. Now, TD does have the largest deposits, but overall, Royal Bank is the biggest bank. Now, CIBC has been my favorite throughout the whole pandemic. I was grabbing Canadian Imperial Bank of Commerce, CIBC, with a dividend over 8%. When it dipped, when it was down here, it was over 8%. It was actually bordering, I think, along 9%. I got it at like 8.5% dividend. And that is ridiculous. And of course, this bank is one of the banks, again, who's been paying a dividend close to 140 years. That's absolutely amazing. The reason why I would actually say stay away from some of the Canadian banks at this point in time is because of this, and I mentioned this with Royal Bank. Its 52-week high is $111. It's currently sitting at basically $111. You're not that far off. You're like $1.20 off, $1.13 off your all-time high. Because of that, I would wait for a little bit of a dip, because of course, when you start zooming in, you can sort of see a bit of a trend there, and you can sort of see a bit of a trend happening there. So of course, I think it could come down, possibly just a bit, which would bring it down to about 104-ish. That might be a good time to possibly get it, as long as we can get out of this pandemic fast. And for a while, it was either last year or the year before, CIBC was literally raising their dividend every quarter. They are making a killing. And remember, banks like TD, who are in the States, actually got a lot of payment back from the government for accepting those stimulus checks. I think TD made a couple $100 million or tens of millions from transaction fees. Like, they're going to make money no matter what. These are the banks. Their whole objective is to make money. So, of course, Bank of Nova Scotia is my next pick, and the reason, of course, for this one is going to be the fact that it's not necessarily very high to its 52-week high. Its all-time high was in the 80s, so, of course, there is some room to run. But you have to remember that they were not having fantastic times before the pandemic. They were starting to recover just a bit, and then the pandemic hit. Now, Bank of Nova Scotia has heavy ties to the Bahamas, all those little different islands down there, as well as Europe. And of course, Europe wasn't having a fantastic time either. So this one is, of course, a good pick if you're looking for a higher dividend. Same as CIBC has a 5% plus dividend as well. And it is farther away from its 52-week high, and of course, very far away from its all-time high. But again, you're always going to be looking at the Canadian banks, and really actually a good investment strategy with the Canadian banks is to always buy the ones that are not doing so well, because they just keep on flip-flopping. For 2 years, there's going to be one not doing so well, like National Bank a couple of years ago, where I was grabbing it up at 6+% dividends, and then they exploded. I'm up like 70% on that trade, and that's only within I think it's 4 or 5 years or somewhere in that range. So that's just one of the ways that you can make money with the Canadian banks. Find the ones that are not doing so well, as long as it's not catastrophic, and then start investing a little bit at a time, and then just wait for it to go up, and then find another Canadian bank, and just keep on going with the ones that are not doing so well. That is an investment strategy that a lot of Canadians actually do. BMO is actually one of my favorites during the pandemic. So it dropped and just absolutely died during the pandemic. You're looking at a close to 40% drop. That's more than most other Canadian banks. Most of the Canadian banks were down roughly in the 30 ish range. This one, Bank of Montreal, dropped close to 40, which was massive. And you were able to grab their dividend when it was like in the 6-7% range and even higher at one point. I think it was up to close to 8. And this was a fantastic pick back then. Is it a fantastic pick now with this increase? Well, of course, anytime that you can break out of your trend, and it's happened a few times here, and then it absolutely exploded out of its trend because it was starting to come to a point. This is fantastic, and of course, it's still away from its 52-week high by about $6.70, and it's still away from its all-time high of roughly $109-ish. So this has still got some room to run, especially after this pandemic. And of course, it is a 4.3% dividend, which is lower than banks like CIBC and Scotiabank. But again, fantastic outlook when it comes to the stock price. This current increase in stock price is also very good to see and very happy to see. The PE ratios are another thing that a lot of investors look at when you look at the Canadian banks. The lower your PE ratio, the more of a chance that you will see an increase in stock price very soon. That is just something, usually when it gets to around 10 is the number that a lot of investors will start investing with Canadian banks. Now, National Bank has been really, really strong over the last couple of years. It never really came off of an all-time high prior to the pandemic. Before the pandemic, it was actually at an all-time high, which is fantastic. And when we're looking at the 5-year chart, this is actually when I was buying it, was back here. And if you could pick it up here, you were again getting that 6% dividend. But like I was mentioning, anytime that a Canadian bank is having some issues, that is when you start wanting to buy in. Of course, there is risk involved with doing that. The PE ratio back here was in the 8 point something range. I think it was 9-ish. And whenever, again, PE ratios drop below 10, that is a fantastic buy usually to buy Canadian banks. And of course, they hit an all-time high and just absolutely got destroyed by the pandemic. They've had a very fast recovery, one of the fastest recoveries out of all of the Canadian banks as well. And they do pay a close to 4% dividend. So if you're looking for a bank that has some room to run when it comes to stock price, was on a very good trajectory before the pandemic, and was actually a very healthy bank before the pandemic as well, this may be a very safe pick for your portfolio. Again, always check with a certified professional who you trust. So this is another bank that hit its all-time high way prior to the pandemic. Unlike National Bank was the only one that was going really strong into the pandemic. Now, TD did hit a very low before the pandemic in 2019, hit an all-time high in 2018, and of course, just basically stagnated before the pandemic. And when you really look at a lot of the different banks, whether you look at American, European, or Canadian banks, there was this whole year of nothingness, just not moving at all, which usually tells you that there's going to be a downturn coming very soon to a market near you. So it was almost like if the banks were actually basically saying that there was going to be something bad happening very soon. And of course, we have the pandemic. Now, TD is another one that is very similar to BMO, but recovered fast early like National Bank, stagnated. And then recently they had their earnings call. They blew out earnings, same as BMO. And of course, they absolutely rocketed higher. Now, out of these 6 banks I showed you today, TD has one of the lower PE ratios, an average dividend across them all, 4.5%. That is why TD right now is my biggest pick, my number 1 pick for the Canadian banks. So right now, I would be personally looking at National Bank if you want to have a safe pick. TD if you want some explosive gains, because of course they're really heavily into the American market. And in the American market, well, they were opening for a while, and then, well, of course, this whole pandemic is starting to hit them again. So I don't know what's going to happen in the future with that one, but of course, TD is set up really well for the future. I hope that you have enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.